Let's turn now to Finance Application 8. We just did number 7 where we calculated the firm's cost of capital. And that exercise, you in a very general way came up with the beta for your firm using some of what we're going to talk about here. In this exercise, beta is so critical for distinguishing the cost of capital between one firm versus another. It's one of the areas of finance where I think firms are a little bit sloppy. There's some firms, we'll probably talk about it in class, some pretty amazing stories of just major money center banks or major corporations that this discussion on the cost of capital, which, as we said, drives every major decision they make, and it's very poorly put together, just very sloppy. It's just a number they've been using for years and no one knows why. So I'm encouraging going through this process, as you talk about your firm and how they come up with their cost of capital, I just ask about the rigor. How rigorous is it? When's the last time you thought about how this was being done? So this is an approach. I think it's a very good approach. It's an approach I've been using for years, and I have actually one of the leading professors here in the country from New York Stern School of Business, Dr. Damodaran. Is amazing. I was watching one of his graduate level classes, and his approach is essentially identical to what I do. So it's amazing. There's others using this exact same approach. I'm sure he didn't steal it from me. I didn't get it from him. It's an approach that came to my mind in talking to a portfolio manager several years ago, and his view of beta, and he essentially threw beta out entirely. But I don't want to do that. I think beta is a very good concept. I think it's a good way to approach coming up with the cost of capital for your firm or your entity, but it needs to have some rigor to it. So what this exercise does is say pick a company. So you want to come up with a beta for a company of your choice, has to be publicly traded, has to have at least 10 years of history, and you'll see why when we're doing this. And this particular chart, we're going to do the historical chart, which is just one part of this analysis, but was the most Excel-based part of it. This is something I got from that portfolio manager and how he talked to my class, because he actually did historical rolling betas, and I think they're much more powerful. It's not the typical way it's taught in the college curriculum. In class, I might show you the typical way it's done. I hope I can convince you this is a more rigorous approach to actually come up with your beta. And so let's go through this. What I'm going to do is I'm going to do this exercise for Packer, which is the firm you had in your problem set 2 for problem set 7. Packer, their ticker is PCAR. So we're going to do that. You'll notice that the beta chart's not in there yet for exercise 7. So I'm going to create it right now when I do this for you. So we'll walk through this process. So let's go into Yahoo Finance. You can see the market was up a bunch on the day I did this. The day before this, the market was down like 5%. So markets are volatile when I'm doing this analysis, but I just come over here on Yahoo Finance or finance.yahoo.com. I just type in the ticker PCAR, and you'll see that the firm comes up, Packer. And when the firm comes up, you can look over here. You can see there's a button that says Profile. You can click on the profile of the firm, and it'll tell you about it. Now, Packer is a manufacturing firm. They build engines. They build trucks, so heavy-duty commercial trucks, usually diesel trucks. So major manufacturing. They're in the shipping line. You know, as shipping's doing well, they're going to do well because these shipping industries will be buying more trucks. You know, it'd be interesting to see to whom they sell their trucks to. Obviously, there's a lot going on in this industry, especially with what's going on with Amazon and Amazon Prime, and they're delivering their own sales. So it's an interesting industry, but if you look at what we're doing here in this exercise, there's 4 things we want to talk about. So I'm going to go into Excel. I'm going to split this into 2 pieces. The first part 1, is we're going to talk about the firm. So PCAR, who are they? So I'm going to bring in that discussion of the firm. I'm not going to edit it anyway. I just want to have it as a reference. So I'm going to bring that into to Excel. You don't have to do this, but you might want to at least have some sense of your firm, who they are, and maybe in a couple words. So so there's the firm. Let me stretch this down so we can see it. And so you can do this entire problem in Excel. You don't have to do this like in a Word document and make it fancy. It can all be in Excel. So looking at this firm, I'm going to start off with step 1. And that's where we talk about the revenue sensitivity. So I'm going to say this is definitely a cyclical company. Now, we talked about with Kroger's when we did the financial application 7, Kroger's was definitely a defensive company. This is a cyclical company, a manufacturer of large trucks. So we think about cyclical companies as being those that they create something that's not a staple. It's not something we buy all the time, but it's a product that is sensitive to the economy. So when the economy is doing well, they're going to do very well. When the economy is not doing well, they're going to do very poorly. So I would say beta well above 1. That's going to be my answer for this firm. Let me wrap the text here. I wish Excel would do that automatically. Well above 1. Now, when we go back into Yahoo Finance, you'll notice up at the top it says summary. When you click on summary, this is what most schools do. I don't like this approach, but they just go to the summary, and there's the beta right there, 1.16. Why can't we do that? Well, what you'll notice is this just happened in beta. This is what we call regression beta or historical beta. And it's a 5-year monthly. It's the same thing we're going to do, except we're going to calculate many rolling 5-year monthlies. But this is just their beta the last 5 years using monthly data. And what you're going to see, and this is what the eye-opening to me when I had that portfolio manager talk to my class, is that betas are very, very unstable. They're all over the place, up and down, up and down, up and down. So using just this one beta number, that may not be the correct number. I've seen some incredibly interesting betas. I've seen Ford Motors. You know, obviously you think that's a cyclical company. They build cars. It's a highly levered company. You would think their beta would be 1.5 up to 2, and yet there's a point in time where their beta was 0.6, like a grocery store. And that's just because the period of time they just happened to be looking at, that's what their beta was at that time. But what you're going to do here is you're going to assess this firm without looking at that beta. What do you think about that firm? So I think this is a beta well above 1. I don't think 1.16 is well above 1, but we'll see. We'll do some extra analysis. The second step we're going to have, step 2, is operating leverage. So I'm going to say I would assume operating leverage. Remember, operating leverage, fixed costs in their cost structure is higher than average. Why do I say that? Well, it's manufacturing, so it's probably unionized workforce, which means it's hard for them to lay people off even when the economy is doing badly. Even when they do lay people off, there are certain things they have to keep providing, like health care and pensions and other things. It has a high property, plant, and equipment. So high depreciation, which is a fixed cost. I know it's not an economic cost, but it is a fixed cost. So I'm going to assume this is a high fixed cost company. So let me wrap the text again. Again, I wish Bill Gates would do that for us, but he doesn't. So I have to wrap it myself here. So that's my assumption. Again, so my step 1 says well above 1. My step 2 says well above 2. However, there's one other thing we can do as step 2. This is my theory. I have not seen many other professors talk about this. So this is purely a professor suite thing. So you can't just bring this up at work and they know what you're talking about unless they've had my class. But my argument is firms with high fixed costs should have very volatile margins. And we'll definitely talk about this some in class. And so there's a spreadsheet I provided to you. It's called the Bloomberg Data for Beta. And when you load it up, it's just going to have this screen. And in cell C6, it gives you the instructions. You just hit the equal sign and you go to the pace values page. And it's alphabetical. And you just go down the page until you find your company. So we're looking for Packer. So go down to the P's. Went a little too far. PCAR. Getting really close here. There it is, right there. PCAR, enter. And that brings in their data. So what I'm going to do is I'm going to take this entire thing and I'm going to copy it. And I'm going to bring it over to my Excel. I'm going to paste it as numbers, and then I'm going to paste it again as a formats. And now I have the data that I need. Let me expand this out. So I have two margins here, and I have to be real careful what this is. This right here and this right here, these are not their gross margins. Packer's gross margin is not 1.5%, and their net margin is not 2.57%. Remember from the first paper you did for the class, we were looking at gross and net margins. Obviously, gross margins should be much, much higher than net margin. A 1.5% gross margin would be terrible. This is actually the standard deviation of their gross margins, the standard deviation of their net margin. And what you'll notice is the typical stocks standard deviation, this is the median of the S&P 500. This is actually the Russell 3000, so I need to change this, but it's of the market. The median is 3.72%. Packer's gross margin is actually much more stable than the average stock. And their net margin, which is really where you should focus in on their net margin because that's where all the fixed costs are, their net margin is much lower. So I need to adjust my discussion. However, the standard, deviation, wow, I used to be able to type, of their net margin is well below that of the typical U.S. stock rank in the top, where was it? Top 20.5%, suggesting their fixed costs are not that high. So my intuition is very different than what their numbers show. What do you do with that? You'll just have to say, what do you go with? Your intuition or what the numbers show? So I'm going to say, I still believe they have higher than average fixed cost, but we'll temper it somewhat given how stable their net margins are. All right, so some way to kind of bring all that together. There is no obvious answer. I know in your accounting classes you talk about fixed costs and variable costs. The problem is you can't just go to a financial statement and get the fixed and variable costs. Accounting really doesn't provide that information at all, and it's actually really complicated to get that information. So this is my approach. There are other ways of doing it we may talk about in class that are really, they make more sense to do, but the data is just not available. So I actually think this is a pretty good approach. So that's our step 2. I'm still above 1 with my step 2, but I am a little surprised at how stable their margins are. Step 3, it's a pretty straightforward one, a very straightforward one, which is their financial leverage. That is the level of debt. And this one's really straightforward. In this table you bring over, it shows you their debt to equity versus the typical stock. And you can see that Packer's debt is really quite high. So I'm going to bring that into my analysis. Packer's debt to equity is well above the typical U.S. stock, pushing its beta much higher. You don't have to say much there, just acknowledge that. So there's step 3, and that's, you can do entirely by just referencing here. You notice on step 2, I referenced the chart, but I also gave my subjective opinion about the company, just based on what I think about the company. You don't have to worry about that part of the problem of whether I agree with you or not. As long as you're logical, you're fine. It can be really complicated in some companies. McDonald's is a good example. You might think, wow, variable costs because I have all these hourly workers. Well, McDonald's really doesn't have hourly workers. A McDonald's franchise has hourly workers, but McDonald's, the corporate that provides the franchises, they don't hire the workers. The franchises do. So you have to think somewhat through the corporate structure and think through exactly how this firm. So what your intuition tells you could be very, very wrong, just because you're thinking about a franchise versus the actual company, or you may not be aware of just some flexibility. Like Ford, I mentioned Ford. Ford does produce cars, but it also has Ford Motor Credit. For Ford Motor Credit, which is essentially a bank, is a very different business than Ford, and that could be the reason why Ford's beta is surprising in its level sometimes. All right, so step 4 is look at the history of beta. And so what we're going to do is we're going to do a rolling 5-year beta using monthly data. The reason we're doing 5 years of monthly data is because that's what Yahoo Finance does, which means the very last number we calculate should be very close to what Yahoo Finance shows. It won't be exactly, because I think they use intra-month data that I don't like to use, so it might be slightly off, but it should be very, very close. Now, Yahoo Finance has been all over the place. They've used 3-year monthly data, they use 5-year monthly data, they use 3-year weekly data. Right now they're using 5-year monthly data, so that's what we will do. So I'm going to move that and do this over on this next sheet, and let me show you that process. There, I'm going to actually stop this video and make this 2 videos. So you can get this part done before you get to the historical, and that's really actually the better way to do it. I really think you should come up with what you think the firm's betas should be before you actually see what the actual numbers are. You don't want to see the numbers and let that somewhat skew your opinion. I really do think beta is not a number that you look up in Yahoo Finance. It is a number you forecast. It's subjective. It requires some intuition. It's your opinion. History gives you some insight, but don't let history skew your opinion until you've stated your opinion.